A completely ordinary investment, an ETF, an index fund, a managed fund, the kind of things sitting in portfolios everywhere, can trigger one of the most punishing tax regimes in the entire US tax code, just because it happens to be foreign. It's called a PFIC. And if you're a US citizen with any Australian investments outside of a narrow set of exceptions, there's a real chance you already own one without knowing it. In this video, I'll explain what actually makes something a PFIC, why the rules are so harsh, and why this catches so many careful, honest taxpayers off guard. Quick context: I'm a CPA here in Australia and an enrolled agent in the US. This video is general awareness of how PFICs work, not personal advice and not a how to guide. Whether a specific investment of yours is actually a PFIC depends on real numbers only a professional review can confirm. In plain terms, the IRS asks two questions about a foreign fund or company. First, where does most of its income come from? If 75% or more comes from things like interest, dividends, or investment gains, rather than an actual operating business, that's one path to PFIC status. Second, what does it actually own? If half or more of its assets are sitting there to generate that kind of passive income rather than being used to run a business, that's the other path. A fund only has to fail one of these two tests, not both. And here's a detail that surprises people. Even plain cash sitting in the fund counts as a passive asset. A business holding cash reserves before it's deployed can accidentally tip into PFIC territory without doing anything unusual at all. Here's a rule that catches people completely off guard. Once an investment is classified as a PFIC at any point while you own it, it stays classified that way, even in later years when it no longer meets either test. This is generally known as the once a PFIC, always a PFIC rule. A fund that only briefly held excess cash in its early years or went through one unusual year can carry that label for as long as you hold it. There is no automatic exit. If nothing else is done about it, a PFIC falls under what's called the default regime, and it's genuinely one of the harshest calculations in the tax code. Here's the plain language version. When you eventually sell or receive an unusually large payout, the gain doesn't just get taxed once. It gets spread evenly across every single year you held the investment. And each of those years gets taxed at the highest tax rate that applied at the time, regardless of what your actual tax rate was back then. On top of that, interest is added to each of those years separately, as if you'd owed that tax all along. There's no capital gains treatment under this default approach. None of it. A long term investment gain that would normally get a preferential rate is instead taxed as ordinary income, is spread across years with interest stacked on top. Quick recap. So far, two simple tests decide PFIC status. Once you're classified, there's generally no automatic way out. And the default tax treatment spreads your gain across every year you held it at the highest possible rate. Two more things worth knowing. When you sell a PFIC under the default rules, there's often a mismatch with how foreign tax credits work. Australia might tax that same sale in the year it happens, but the US spreads its version of the tax across all your prior years of ownership. Because the timing doesn't line up, the credit for tax paid in Australia often can't be used to offset the US tax on those earlier years. The result can be genuine double taxation on the same sale. Not because anything was hidden, just because the two systems calculate the timing completely differently. Even putting the tax itself aside, there's a real time cost. The IRS own estimate for the paperwork behind a single PFIC, one form for one fund for 1 year, is close to 49 hours between record keeping, understanding the rules, and preparing the form. And that's for one fund. Someone with a handful of foreign ETFs inside a portfolio or a super fund could be looking at that same burden multiplied several times over every single year. This video covered what a PFIC actually is and why the rules are so harsh. In a follow-up video, I'll cover exactly where PFICs tend to hide, inside super funds, inside Australian companies, and in ordinary personal portfolios. Plus, a specific trap for anyone catching up on late filings. Subscribe so you don't miss it. None of this means every foreign investment is a disaster waiting to happen. Plenty of holdings fall under exceptions or under a small enough balance that reporting isn't even required unless something triggers filing requirements. But the two tests that create PFIC status are broad enough that it's genuinely easy to hold one without realizing it. There are elections, ways of choosing how a PFIC gets taxed that can meaningfully change this picture. But they depend entirely on your specific fund, your paperwork, and your timing, which makes this a poor fit for a general video and a good fit for an actual conversation about your own portfolio. If you want to talk through your specific holdings, I offer a fixed fee PFIC Exposure Clarity Call, a scope conversation to identify which of your investments are likely PFICs and what that means for your US filing obligations. Not a full engagement, link in the description.